Here is your rewritten version of the story. I've kept the exact same structure or length, flow, paragraph breaks, calls to action, questions, historical references, tone, and all key points intact. Only the words, alfaz, have been rephrased and varied to make it original and avoid any direct copy issues, while preserving the full meaning, intensity, and persuasive style. Stop everything, because if you look away for even a second this week, you'll miss the shift that's about to redefine conversations around silver for a long time. Triple digits. Not a fleeting spike, not a quick touch before dropping back. I mean silver actually reaching $100 and staying there long enough to mark a permanent line across every chart, every short position, and every skeptic who insisted it was impossible. The wildest detail? This wasn't some retail frenzy built on margin calls and hype. This surge carries clear signs of genuine physical demand, serious purchasers, and genuine tightness in supply. Before we dive deeper, let me say this once and move on. I'm actively working to shut down imitation channels. If you appreciate this content, show your support immediately. Subscribe and leave a comment with Arjan AG so I know who S truly with us. Here's the statement that will hold this whole discussion together. Today is Saturday, January 24th, 2026. Right now in New York, it's 12:47 p.m. Leave a comment below. Share the exact time you're viewing this, because I want to gauge how worldwide this instant really is. Okay, let's break down exactly what occurred, the reasons behind it, and why the upcoming phase might be far more intense than what we've already seen. The online space is already packed with folks offering the usual tired explanations. Hype, excitement overload, excessive enthusiasm. If you buy into that narrative, you're setting yourself up for a painful misjudgment at the worst moment. Here's what's actually taking place. When silver explodes upward like this, the very first question you need to ask is, who's willing to pay these levels, and what's driving them to do it immediately? There are essentially two types of silver surges. One is driven by paper trading. Leverage, media buzz, and momentum carry it briefly before it crumbles like cheap furniture. The other is rooted in physical reality, where the market genuinely requires the commodity, and the normal dynamics shift dramatically. This week strongly resembled the latter, and I can already hear some of you thinking, all right, fair enough. Claims of physical shortages have circulated for years. Why trust them today? Valid point, but stick with me, because the evidence is aligning in patterns we rarely witness. And it's not isolated to a single nation, exchange, or region. We're seeing what looks like synchronized premium pressure from buyers in various parts of the world. That kind of alignment is uncommon. Begin with the most basic clue. When a resource is genuinely scarce, the market refuses to sit idly by for the quoted benchmark. Purchasers aren't patiently checking quotes for a dip. They step in and pay whatever is necessary to lock in material, because missing out costs far more than overpaying. That creates an upward pull that feels almost magnetic. That's precisely why premiums are critical. Premiums reveal the underlying truth long before the spot price catches up. Recently, the extra amounts paid for bulk silver bars, particularly those destined for industrial use and major investment purchases, have been screaming one thing: we need this metal today. Not in 30 days, not in 90. Right now. There's a specific reason silver can deliver shocks like this. Silver isn't merely a preservation asset, it's an industrial workhorse. It gets consumed in the process. It feeds into circuit boards, photovoltaic cells, healthcare equipment, advanced compounds, conductive switches, and thousands of tiny parts that stay invisible until scarcity hits. Gold can rest untouched in storage for centuries and remain unchanged. Silver gets dispersed, embedded, and effectively lost in microscopic amounts throughout countless products. That distinction is huge, and this is where the narrative becomes even more compelling. Silver's supply dynamics are unusual. Unlike typical resources where elevated prices rapidly spur output, silver production often resists quick expansion. Much of it arrives as a secondary output from operations targeting copper, lead, zinc, or gold. So even when silver prices soar, primary miners don't suddenly ramp up silver-focused efforts. They simply can't. Their main profitability hinges on the dominant metal. Silver rides along as a side benefit. Keep that idea in mind because we'll link it directly to current warehouse levels and exchange holdings. But first, let's examine the nations that keep surfacing: China and India. Many try to frame this as a basic East-West clash, but the situation is far more layered, and that complexity holds the real potential. When consumption surges in a large user country, it appears through several channels: higher import volumes, declining regional stocks, elevated local markups, or frequently a combination. When several indicators flash simultaneously, it's like smoke seeping from beneath a closed door. You might not witness the flames yet, but you know trouble is brewing. So what signs are visible at present? 1. Reports and data point to declining stocks at major distribution points. 2. Markups indicate urgent need for immediate physical delivery. 3, buying enthusiasm is spreading past the typical Western ETF participants into areas where tangible ownership has deep cultural roots. That shift is significant because buyer habits vary. Some trade electronically, others acquire bars and store them indefinitely. When the market transitions from digital clicks to metal exiting circulation, available supply tightens, and each unit of buying power exerts greater influence. That's the moment silver shifts from a steady performer to something coiled and explosive. Now, I'm about to state something that will irritate certain viewers, and that's perfectly okay. Many of the most vocal commentators are still operating from outdated assumptions, treating this like 2011, where silver was merely a high-leverage chart play. But the current environment rests on a different foundation. Today's momentum stems from persistent industrial requirements, slamming into a sluggish and limited production channel. Sure, speculative interest piles on, it always does. But speculation isn't the core driver, it's the fuel that intensifies the fire. Speaking of fuel, let's confront the topic many avoid. What occurs if confidence erodes in the deliverable silver sitting on exchanges? I'm not claiming it's certain. I'm saying it's precisely the sort of doubt that can become self-fulfilling. Once major participants begin questioning whether metal would actually arrive if they demanded delivery, everything transforms. Paper positions can balloon enormously, but the physical pool available for settlement is finite. That distinction is crucial. In numerous markets, exchange inventories function as buffers. Demand surges get cushioned. Supply floods get soaked up. But when stocks decline amid climbing consumption, the buffer becomes a launcher. I'm not using alarming language for attention. I'm aiming to help you reason logically. The logical view of silver is straightforward. It doesn't need to vanish completely for a major repricing. It only needs to become difficult and costly to obtain at previous levels. Difficulty suffices. Delays suffice. A handful of determined buyers paying premium suffices. Once that threshold crosses, the worldwide benchmark begins pursuing whoever shows the greatest urgency. That leads us straight to the mental aspect. One reason silver stands out as a legendary asset is its refusal to advance gradually. It doesn't climb steady steps like certain investments. Silver remains dormant, then erupts. It lulls participants into complacency, then penalizes inattention harshly. When it breaches a psychological barrier like $100, it transcends mere valuation. It becomes news. It becomes a mindset hurdle. It becomes validation that draws fresh attention, and the market understands that power. But don't misunderstand. Hitting the round figure rarely marks the conclusion. Frequently, it signals the start of the riskiest segment, where many conclude it's finished, only for the market to deliver the harshest surprise. It continues climbing regardless. Let me share a historical detail most conveniently overlook. The most dramatic silver episodes never arrive with fanfare. In early 1980, the average person didn't wake up expecting a peak that day. Momentum built, coverage intensified, and volatility took center stage. In 2011, the true damage didn't, IT, occur on the exact high. It came during the brutal reversals that shredded certainty. The takeaway isn't that silver inevitably collapses. The takeaway is that silver behaves dramatically, and dramatic environments require strict discipline. So when I warn that things could intensify further, it's not to frighten you, it's to equip you, because entering triple-digit territory wakes up compliance departments. Brokers impose stricter conditions. Funds recalibrate risk models. Producers and users reevaluate protection strategies. And the group that matters most, the shorts, begin calculations they dread. Here's the unspoken reality many avoid. Much short interest in commodities isn't cartoonish malice. It can represent legitimate hedging, liquidity provision, or balanced positioning. Yet during rapid repricing, those positions still demand active management. And risk control frequently involves repurchasing during rallies. That produces the painful kind of advance, where gains occur not from universal joy, but from forced covering. That prompts an honest question for you. If silver retreats to, say, the mid-90s after hitting $100, do you view it as the conclusion? Or as preparation for the subsequent leg higher? Share your view in the comments. I read them carefully and let them guide future topics. Now, let's shift briefly to an overlooked currency perspective. When precious metals advance sharply, it's easy to declare silver is outperforming. But you could equally say currencies are losing ground, and that isn't mere metaphor. Across extended timeframes, paper money consistently erodes in buying power. The pace varies, gradual for some, rapid for others, but the trajectory remains downward. Metals simply reflect that erosion objectively. That's why we witness unusual historic breakpoints where silver sets highs not only against the dollar, but against multiple currencies simultaneously. When that occurs, residents in those areas face an uncomfortable question. If silver behaves this way, what does it reveal about our currency's strength? Here's an additional angle. Certain people still view select currencies as exempt, as if one particular fiat escapes the universal dilution process. History shows some have resisted better during specific periods, yet in an era of mounting obligations, shifting populations, and unfunded commitments, even resilient currencies eventually feel the pull. So when silver surges in regions once considered shielded, it serves as a warning. The erosion process doesn't request approval, it simply proceeds. Okay, now let's examine the companion white metals, because 2026 could deliver surprises here too. When silver captures focus, it frequently illuminates platinum and palladium as well. Not due to perfect similarity, but because investors group them mentally, precious metals excluding gold. Each has its unique narrative, restricted production, heavy industrial reliance, and occasionally thin trading conditions when sentiment shifts. Platinum has spent long periods trading at deep discounts to gold, and mean reversion in that spread can unfold rapidly. Palladium has experienced extreme swings thanks to concentrated usage and supply vulnerabilities. I'm not urging you to pursue any of them. I'm urging awareness of the interconnections, because bull phases frequently rotate across related assets. Here's a straightforward method to analyze without advanced tools. Focus on ratios. Ratios slice through confusion. Silver rising while equities fall tells one tale. Silver rising alongside equities tells another, but the clearest insights come from pricing silver against alternative stores of value. So consider silver relative to equities, silver relative to property, silver relative to gold. The objective isn't forecasting the next bar. The objective is determining whether we in the opening act or the final stages of a larger adjustment. Start with equities. In confident times, capital floods into expansion-oriented names. Multiples expand, stories dominate. In uncertain times, attention turns to tangible yield, durable assets, and items independent of future projections. Metals often gain during that pivot, particularly when real rates sit low or negative. Next, real estate. Housing provides a tangible yardstick. People grasp home values. People grasp shelter costs. Calculating how many silver ounces purchase an average residence delivers an unfiltered perspective that overrides online debates. In certain periods, metals acquire less property. In others, metals acquire far more than expected. That oscillation isn't arbitrary. It mirrors the relative overextension between financial claims and physical reality. Finally, silver versus gold. The gold-silver ratio remains one of the market's longest-running indicators. It doesn't explain everything, but it signals when silver leads or trails. Compression means silver gains dominance. Expansion means gold holds the safer position. During genuine precious metals advances, gold typically initiates, then silver accelerates. If that sequence is recurring, triple-digit silver isn't standalone, it's one chapter. Here's the suspense element. If this represents a chapter, what follows? Triple-digit silver alters conduct. It reshapes thinking. It influences corporate sourcing. It affects scrap recovery economics. It impacts exploration budgets. The market requires time to process those adjustments. Yet, the processing phase itself often generates heightened swings rather than calm. Let's discuss sourcing, because this turns abstract concepts concrete. If silver forms a critical component for your production, you prioritize reliability over excitement. You seek consistent availability and foreseeable expenses. When prices spike, companies respond with extended agreements, buffer inventories, alternative material studies, and often cost pass-throughs. Those responses begin gradually, then accelerate. The challenge? Replacement isn't straightforward. Silver possesses unique traits, electrical efficiency, light reflection, reactivity, that resist easy substitution in key uses. Designers can trim quantities, re-engineer parts, or explore alternatives in limited cases, but not swiftly or universally. Consequently, industrial consumption remains resilient even at elevated costs. It evolves rather than evaporates. That evolution can sustain a stronger demand base than doubters anticipate. At this stage, someone invariably asks, fine, but won't higher prices unleash massive new supply? It appears reasonable. Yet recall our earlier point. Substantial silver output emerges as a byproduct. Meaningful expansion requires either dedicated silver projects reaching production, which demands years, or broader growth in copper, zinc, and related mining. That hinges on base metal profitability and worldwide industrial activity. Put differently, silver's supply adjustment lags significantly, and lagging supply amid accelerating demand drives prolonged valuation shifts. Now, let's tackle a divisive topic, the notion of silver manipulation. You've encountered the claims, you've watched the exposés, you've read the discussions. My perspective: markets can face interference, imbalance, and strategic pressure, particularly when paper exposure grows enormous. But anchoring your entire outlook on universal rigging guarantees you'll overlook genuine developments. A superior method involves acknowledging framework, motivations, and ultimately physical limits carry the greatest weight. Rather than debating hidden control, monitor tangible metrics. markups, borrowing pressure, stockpile movements, and settlement patterns, because those prove difficult to fabricate consistently. And that naturally leads to leasing rates and borrowing expenses, among the most overlooked signals in metals. Elevated or strained borrowing indicates tightness. Unusual shifts in those rates frequently signal underlying strain. You don't need to fixate on precise figures. Direction and surrounding conditions suffice. Now, a brief side trip to Japan, because an under-discussed development is unfolding there that many outside Asia miss. Japan has operated under near-zero interest rates for decades. That environment fueled enormous carry strategies, borrowing inexpensive yen to fund higher return positions globally. Unwinding those positions during turbulence can send unexpected waves across assets. The crucial element, rising instability and carry reversals prompt rapid de-risking. That can trigger liquidation in certain holdings, yet simultaneously boost appetite for trusted value preservation. When purchasing power concerns emerge among local participants, interest in physical precious metals can surge swiftly. In a major affluent economy, that carries weight. Hence the growing reports of Japanese private buying interest in silver, challenges acquiring specific bar weights, increased discussion of purchases, and the perception that gold has advanced excessively, prompting a turn towards silver. That pattern makes sense behaviorally, but I'll offer a cautious balance. Don't conclude Japanese demand rises solely because gold appears pricey. At times it stems from broader awareness of changing conditions, inflation outlooks shifting, currency trust wavering, or traditional approaches losing effectiveness. Now, if you've profited in this space, silver, gold, equities, entrepreneurship, anything, please share your journey in the comments. I mean it. Viewers need encouragement, and your experience could inspire discipline over reaction. Okay, time to address predictions. Annually, experts release targets like confetti. Some stay conservative, some go aggressive, and most miss widely. The flaw in forecasts? They assume linear, spreadsheet-like progression, yet metals advance in cycles fueled by decisions, sentiment, logistics, and abrupt concern. So rather than fixating on whether silver reaches 120 or 170, ask a smarter question. What environment surrounds us? A gradual climb or a forced revaluation where price must leap to balance supply and demand? In rationing scenarios, large jumps aren't optional, they're essential. Price serves as the regulator. When demand overwhelms, price rises sufficiently to deter marginal buyers. That explains why the triple-digit breakthrough carries importance. It demonstrates the market's readiness to deploy decisive measures. Now, I'll do something conventional commentary dislikes. I'll link metals to broader economic policy without veering into partisanship. Simply incentives and outcomes. Administrations maintain deficits. Monetary authorities adjust rates and money availability. During slowdowns or rising debt burdens, authorities typically select the easier route. Looser conditions, controlled yields, and measures that gradually diminish real debt loads. A byproduct? Tangible assets frequently undergo revaluation. That doesn't guarantee linear gains for metals.